Okay, so you want to own a piece of Tesla. You buy a share, and now you technically own a sliver of electric cars, battery factories, a growing energy business, and, depending on the day, whatever Elon Musk happened to say on social media that morning. Sounds simple. It is not simple. And the story of how Tesla stock actually creates value, and how violently that value can swing, is one of the strangest stories in the entire stock market. Before you own a single share, it helps to know how close this company came to not making it at all. In 2008, Tesla was days away from running out of money. Not slowing down. Days from missing payroll and shutting down completely, in the middle of a global financial crisis that was crushing car companies far bigger and far more established. Musk later said he put in the last of his own personal fortune, along with a final round of funding that closed on Christmas Eve, just to keep the company alive through the following morning. 2 years later, in 2010, Tesla went public at $17 a share, becoming the first American car company to go public since Ford, decades earlier. At the time, it had built exactly one car most people had ever heard of, a modified sports car with a battery in it, and it was still losing money. Almost nobody watching that IPO would have guessed what came next. Here's the part almost nobody expects. For most of the following decade, Tesla kept losing money, year after year, while its stock price kept climbing anyway. That sounds backwards, and in a normal industry it would be. But investors weren't pricing Tesla like a car company. They were pricing it like a bet on whether the entire auto industry was about to flip from gasoline to electric, with Tesla years ahead of everyone else trying to make that switch. That bet nearly blew up in 2017 and 2018, a period inside the company that employees still call production hell. Tesla had promised to mass produce a more affordable car, the Model 3, and it completely underestimated how hard that would be. Robots on the assembly line kept failing. Musk was sleeping on the factory floor. The company was burning through cash so fast that serious analysts openly speculated Tesla then. In August 2018, Musk posted on social media that he was considering taking Tesla private at $420 a share and that funding was, in his words, secured. It wasn't. The stock spiked immediately and then collapsed once it became clear no such funding existed. The Securities and Exchange Commission sued him for securities fraud, and the case ended in a settlement that forced Musk to step down as chairman and pay a substantial fine, while Tesla itself paid a matching penalty. Here's why that moment matters if you're the one holding shares. It revealed something that still defines Tesla stock today. An enormous amount of its price movement is tied not to factories or delivery numbers, but to the words of a single person. That's a very different kind of risk than the kind you'd find owning, say, a company with a large board and a slow-moving corporate structure. With Tesla, one sentence from one man can move billions of dollars of value before lunch. Despite all of that, Tesla clawed its way out of production hell, and what happened next reshaped the entire company's economics. Deliveries started climbing every single quarter. The company posted its first full year of profitability in 2020. And that same year, Tesla was added to the S&P 500, the index that tracks 500 of the largest companies in America, instantly forcing every index fund and pension fund tracking that index to buy shares whether they wanted to or not. That single event helps explain one of the strangest stretches in the stock's history. In 2020 alone, Tesla's share price rose by more than 700%. To keep the stock at a price ordinary investors could still afford to buy whole shares of, Tesla executed a 5-for-1 stock split that same year, then followed it with a 3-for-1 split in 2022. Here's the part beginners consistently misunderstand about splits. Neither one created a single extra dollar of value. If you own one share worth $1,600 before the split, you now own 5 shares worth roughly $320 each. Your total stake was worth exactly the same the moment after as the moment before. All that changed was how many pieces your ownership was cut into. By late 2021, Tesla's total market value crossed $1 trillion, becoming the first car company in history to reach that number, at a valuation higher than most of the next several largest automakers in the world combined, companies that were selling vastly more cars every single year. That gap tells you something important about what you're actually buying when you buy Tesla stock. You are not buying a claim on today's car sales. You are buying a claim on a bet about tomorrow's entire industry, and that bet has always been priced far more aggressively than the actual business happening today. Here's the twist that shows up again and again with this stock. Reaching $1 trillion didn't make owning it safe. In 2022, Tesla's stock fell by roughly 65% over the course of the year, one of its worst years ever, driven by rising interest rates, growing competition from Chinese electric vehicle makers, and renewed concern over Musk's attention being split after he purchased and took over the social media platform Twitter. The factories kept running. The cars kept shipping. What collapsed, again, was confidence in the story investors had been telling themselves about the future. Might not survive the year. This is also a company that has never paid a dividend, not once. Every dollar of profit has gone back into building new factories, expanding battery production, and funding research into self-driving software and robotics. If you're holding Tesla stock hoping for a regular cash payout the way you might from an older, more established company, you're holding the wrong stock. The entire bet here is on the size of the forest growing, not on collecting fruit along the way. There's another layer to Tesla's economics that barely exists at most other car companies, and it comes from something most people don't think about at all when they picture a car business. Regulatory credits. Governments in various countries require traditional automakers to hit emissions targets, and companies that fall short can buy credits from companies that exceed them. For years, Tesla sold these credits to competitors who needed them, and in some early quarters, those credit sales were the difference between Tesla posting a profit or a loss on paper. That's a strange kind of revenue, valuable, but entirely dependent on regulations that could change or shrink as more competitors build electric vehicles of their own and need fewer credits to buy. Then there's the part of the company that rarely makes headlines but has quietly grown into a real business of its own. Tesla's energy division, selling home batteries, solar panels, and massive grid-scale battery storage systems to utility companies. It's a much smaller piece of total revenue than car sales, but it's also growing faster than the car business in some recent years, and it gives Tesla a second engine that doesn't depend entirely on how many vehicles roll off the line each quarter. Which brings us to the risk that sits underneath almost everything else. Concentration, but a different kind than most companies face. It isn't just that Tesla depends heavily on car sales. It's that an enormous amount of investor confidence in the entire company is tied to one individual's reputation, decisions, and time. When Musk's attention, public statements, or other business ventures become a source of controversy, the stock has repeatedly moved on that alone, separate from anything happening on a factory floor. Few, if any, companies of Tesla's size carry that particular kind of risk this visibly. So does owning Tesla actually work economically the way people assume it does? The honest answer depends entirely on which few years you're looking at. In the optimistic version of the story, a nearly bankrupt startup outworks the entire legacy auto industry, becomes profitable, gets added to the most important stock index in the country, and turns early believers into the kind of returns that show up in finance textbooks for decades. That's the version that made Tesla one of the most talked about stocks of the last 15 years. In the harder version, competition intensifies, delivery growth slows, interest rates rise, and the stock can lose more than half its value in a single year, even while the factories keep running exactly as planned. Neither version is theoretical. Both have already happened to this exact company, sometimes within 18 months of each other. That's the real lesson sitting underneath every trillion-dollar headline and every stock split announcement. A car company doesn't look, from the outside, like one of the most volatile large stocks in the entire market. It looks like a car you might drive, a factory you might tour, a name you already recognize. From the inside, it's a financial system where regulatory credits, a second energy business, index fund buying, and the public reputation of one individual are all quietly tied together in a way that barely resembles how a traditional automaker's stock behaves at all. So let's go back to where this started. A company that nearly missed payroll on Christmas Eve became, for a stretch of time, more valuable than most of the auto industry combined, and the economics behind that climb reveal something bigger than any single stock chart. Owning a share was never really about owning a car. It was about owning a claim on a bet that the entire world was about to change how it gets from place to place, a bet that could have just as easily failed in a Fremont factory back in 2008. If a company that came within days of running out of cash can become one of the most valuable businesses on earth, and just as easily lose more than half its value the very next year, what does that tell you about the difference between believing in a company's mission and understanding the price you're actually paying for it?